Okay, good morning. Welcome to the investment meeting for the Teachers Retirement Board for November 6, 2025. I'll start by calling the roll. Brian Berge,
Brian Berge, representing Mayor Adams.
Thomas Brown.
Present. Good morning, Patricia.
Morning. Gregory Faulkner. John Dorser.
John Dorset doesn't need control of Brad Linder, present.
Victoria Lee. Present. Christina McGrath.
Good morning, present.
We have a quorum, and I'll turn it over to there.
Good morning, everybody. We'll start the public agenda with the passport funds, September passport funds flash report. Mike is going to take that. Thank you. Amanda.
Just pulling it up on the screen there.
Thanks, Amanda.
So we'll walk through results of the passport funds through the end of September. September historically is known as commonly a negative month for market returns, although this year we did see positive results across both equities and fixed income. In part, we saw some strong economic indicators, and also we saw the Fed beginning to restart their monetary easing process, both of which were supportive to market returns. We closed out the end of the quarter at 23.3 billion across the passport funds, 90% of which, or close to 21 billion, sits within the diversified equity option, which was up over 3% for the month of September and up over 15% year to date through the end of 9/30. You can see, looking out at that year to date column, that the diversified equity fund has trailed its custom benchmark, in part due to the fact that we have had a very challenging environment for active managers to outperform benchmarks. So both within the US active manager sleeve and non-US active manager sleeve, we have seen some relative underperformance there. The balanced fund up 1%, 1.2% for the month of September. International equity fund, similar to the diversified equity, up close to 3%. Sustainable equity fund up 1.5% for September. And both of your passive funds, the US equity and international equity, up around 3.5% for September, and tracking their benchmarks as we would expect. You can see there, looking at the year-to-date returns for the two passive funds at the bottom of the page, with the US fund up 14%, the international fund up 26%, that we've seen continued very strong results from international markets year to date, close to 2x of what we've seen from US equity markets. Any questions on September results?
Question for Wanda? Great. We'll move on to the preliminary October.
Yeah, so we don't yet have official October numbers for the passport funds, but can share our monthly benchmark report with index results through the end of October. October, we did see a bit of an equity market sell-off to start out the month, although that was reversed in part due to very strong corporate earnings release for the third quarter, which did help return us back to what has been largely a very upward trend in markets since really mid-April. So closed out the month with positive returns across both equities and fixed income, in the range of 1 to 2% across asset classes.
Yeah. We move on to the public agenda for the pension fund performance update from Steve.
Great. Thank you, Mr. Chair. Just a couple quick remarks. I don't know who's driving today. Donald? All right, now. Here's the first slide. So I'm fortunate. I'm not proud to announce, but I am announcing today is the 36th day of the U.S. government shutdown. And unfortunately, the longer this goes on, the more damaging it will be to the economy. A lot of the numbers we're seeing are stale, but we have been able to piece together some insights into the economy. And as a general matter, in the third quarter, we see growth decelerating. We see inflation rising. We see employment weakening. And yet, U.S. stocks are at or near all-time highs. There's something called the Buffett indicator I was reading about this morning that reflects that valuations in US stocks are bloated at over a market cap of over $72 trillion. So that's more than twice the size of the US economy. It's just an interesting way of looking at things. From a growth perspective, again, decelerating from a pretty rapid growth in the second quarter into the third quarter, but the fourth quarter seems to be slowing down quite a bit. We did have an inflation number out recently, kind of an anomaly. The reason why that inflation number came out, the CPI print came out, was because the U.S. government, there's a law that says they have to provide the Social Security COLA adjustments by November 1st. So they did put people back to work temporarily to calculate the numbers. The outcome was that CPI was up 0.1% to 3%, well above the Fed's 2% target, and core inflation remained at 3.1%, still at elevated levels. Unemployment, again, we haven't really had a great snapshot, but I did read an interesting study from Challenger, Gray, and Christmas this morning that said October, the layoffs in October were the worst they've been in 20 years, and it reflected that it had more to do with artificial intelligence. And we've seen some announcements, and I should mention Challenger, Gray, and Christmas are an outplacing agency. So when people lose their jobs, they help them find their next position and provide career coaching. And they said the last time that we saw a number of layoffs this high in an October period was 20 years ago. It was with the release of the cell phones. And if you remember, that was kind of a transformational technology at its time as well. So just some anecdotal information in the absence of any official reports out of the U.S. government. Say on the far right-hand side, the lower right-hand side, also just a look at currencies. The U.S. has shown some strength recently, the U.S. dollar rather, relative to its international peers, but it's still down over 8% year to date against other currencies on average. On the next slide, so look at rates. Amanda talked about a Fed rate cut in September. We had another one in October last week, which brings the new target levels between 3.75 and 4%. So call it 3 and 7/8. Again, moving down towards what's considered to be a neutral rate of anywhere between 3 and 3.25%, depending upon who you talk to. On the lower left-hand side, just to look at yield curves, the most recent one being in red. Looking back on the gray at the bottom to November, current 30-year yields are at 4.7% today, about 310 basis points above where they were back in 2020 or 5 years ago. So higher base rates, a little bit of headwind for portions of the economy, but I think the market is adjusting nicely to those higher rates. And we do see some relief in rates in terms of short-term rates coming down. On the upper right-hand side, investment grade credit spreads at the margin have widened a little bit. There's been a tremendous amount of issuance, and that's caused spreads to move up just about 10 basis points from where they were. Actually, they're a little above the 78 that we're reporting here. And high yield credit spreads, probably closer to 290 basis points over comparable treasuries, still considered relatively tight relative to historical spreads. Below that, you can see in terms of the reference rates, the 2-year and 10-year yields are both about 15 basis points over where they were when I last reported a month ago. So a little bit of backup in yields, both in the short and intermediate end of the curve, or portions of the curve, I should say. Similarly, gold, the spot rate is right about $4,000 a troy ounce. That is reflective of a little less of a flight to safety, perhaps less retail buying, and that also speaks to some of the strength we've seen recently in the U.S. dollar. So interesting times again, and some of this is related to some of the changes in terms of what's gone on in the tariff front, some of the impact of the U.S. government shutdown, and just maybe a calming of some of the geopolitical risks between the U.S. and China with recent discussions. On the next slide. Not a lot really to talk here. You can see on the left-hand side, world equity markets, including the U.S., up really nicely for the year. We talked about the strength of returns over the last few years, and the S&P 500, for example, and the Russell 3000 have been up double digits now consistently for the first 2 years in 2023 and 24, or 22, 23, 24. It's been about 20+%. Last year was up 16%. The S&P 500 again year to date's up another 16%. I think we talked about this. I like to put Mike, my men on the spot. Average return expectations for US equities, 7% over on average.
Yeah, I would say 6 3/4 to 7%.
So the expectation is for returns to be lower over the next 6 years.
Yes.
It's on a rolling
It's
basis, but
rolling,
yeah. Just to emphasize the point, we really don't know. No one has a crystal ball, but the expectation is for returns to come down. On the world bond market stage, on the far right-hand side, sovereign yields. Again, you can see that yields are not quite as low as they had been the last time we reported, with that 15 basis point back up in US 10s up top. And it's kind of a mixed bag around the world in terms of 10-year yields.
And Steve, just to interject, when you said that the expectations for the next 6 years, when we do the asset allocation, we usually look at a 10-year time horizon.
Exactly,
So
yeah,
I just
that's
wanna-
right, John.
I just want to make that point that
Yeah.
all the things that we've adopted are on a 10-year longer term horizon than the 6 years. Not to discount the 6 years, but
Yeah, no, I said that with a smile because
Yeah.
we have, the
yeah, I
last
just
time we
want to make
looked
sure
at it.
that
Yeah.
for those folks zooming in today that.
Yeah, I know, and I know.
Comments.
I don't mean to speak for Goldman. You want to maybe want to comment? I know you're working on your capital market assumption, what that entails, part of that strategic asset allocation review.
Yeah, no, and I think that, there's sort of the short-term outlook that we have as we look forward over the next year or two. And then there's sort of the longer term capital market expectations that we'll use in the study. And I think part of the art is not so much the science, is how do you weigh sort of the short-term considerations with the long-term outlook in making decisions around the portfolio. And as John was saying, we always really make decisions based on the long term, but we want to be very conscious and aware of what potential downside risks are in the short term. Steve said it before, valuations in equity markets are really quite stretched. It's starting to feel a little bit, we were talking yesterday, it's starting to feel a little bit like the lead up to the tech bubble in terms of how frothy the market is. But there's obviously some underlying fundamental differences in what's also driving sort of continued earnings strength as well, which maybe implies that we're not necessarily where we were 25 years ago when the tech bubble burst. So there's, in our view, reasons to be optimistic, but definitely some other risks that we want to be aware of.
Yeah, the bull market is pretty far along in terms of period of time and percentage. A healthy correction, Mike, would be 10% every couple of years. If
That's been historic, right?
yeah.
Yeah, I think the annualized 10-year return for the U.S. equity market is almost 15%.
Wow. Yeah. I don't think it'll last. Maybe quick look at next slide. Market volatility. It's come down. You could see the spike is when we had the announcement of the tariffs. What is really interesting, I read something earlier this morning that said the S&P 500 is up 36% since its low point in April. Remember, I mean, it's up 16% for the year, but it was way off for a period of time when volatility spiked and prices came down. But that's a heck of a recovery in a relatively short period of time. And that's it. I'll open up to any questions.
Any questions for Steve?
Any concerns with the Supreme Court getting the tariffs thing now?
Well, I don't know about concerns. I do think that might be adding to some of the volatility, particularly maybe around rates. There's questions of the impact on the deficit spending of the U.S. government if they have to return the tariffs that have already been collected. There was a level of skepticism, I guess, raised yesterday in the Supreme Court questioning. I don't think a decision will come out for another several months. But there seemed that the consensus was that the level of questioning and the level of skepticism seemed to indicate that maybe the Supreme Court doesn't think he has the authority to issue tariffs under the Emergency Power Act, but there might be other ways he can do it anyway. So no one has a good sense for what the outcome will be or what the remedies might be, how they may repair this going forward. So I don't know, Mike, if you.
No, I think if frame of reference, 6 months ago, we were talking about tariffs in this meeting. And I think what was sort of the broadest, view among market participants and what was causing the most concern, volatility, it was really just the uncertainty around tariffs. So to the extent we start hearing more about, them being potentially rolled back and then finding other ways to implement it, it just creates more volatility in the markets. And maybe that's enough to spur some sort of correction.
there's a lot of uncertainty in the markets right now. This is just another aspect of it, so.
So is there any correlation between the rise in the stock market over the last several years and the introduction of auto enrollment in 401ks and other plans artificially like buoying the market? Because that money has to go somewhere. And if it's going into passive, which I'm just making a broad statement, many plans have a heavy tilt to it. Many 401k plans and deferred compensation plans have a tilt towards passive, right? So I guess my question is, as more and more people have to contribute and that money has to go somewhere, is it artificially buoying those stocks that are in the index?
Yeah, the outperformance of the index relative to active management, John, that's an excellent point. I think that was also a point that Ed Berman tried to make in that chart that showed the growth of passive management relative to the overall market. It's incredible, and you're right. The interesting thing is those deposits into their 401k, they don't occur in January. They're spread out throughout the year. There's a constant demand of money coming in or flow of money coming in.
Yeah, and I'd be curious if people front fill their deferred compensation plan. Some people like to get it out of the way early.
Bonus.
And I guess the question is, do you see it? And maybe it's too early to look at that. And I recognize we have a noted economist in the room who might have more understanding of this than I do as a layperson. But
Not a behavioral analyst.
not a behavioral analyst. I'm just more curious if you see a trend, or if Goldman sees a trend at the end of the year where the markets are a little more flat because less money is actually going into the plan for those people that end their contributions in October, so that they have a little bit extra in December to spend around the holidays. I mean, and again, it's a behavioral economist question more than it is how the markets function. But I'm just kind of curious if anybody's looked at that.
I haven't seen a specific trend that's been noted, but to your point, people are hitting, in many cases, not in all, but in some cases, limits throughout the year, which could imply then that there's less deferred savings later in the year. I think I haven't seen any sort of definitive trend.
I mean, I'm putting you guys on the spot. I mean, it's just kind of out there. I was just curious.
Yeah.
Yeah, I tend to, when we talk about capital market assumptions, and Mike, I'm not just saying this because you're here, but I tend to have a very high regard for what Goldman Sachs thinks because of where you sit in the world, the ecosystem you operate in. You see flows for both issuers, high net worth individuals, institutional flows, or an investment bank. There's so many things that a Goldman Sachs sees that they can take into consideration for capital market assumptions. I'd say the last point I would make, and the one thing that I really truly, and I'm being sincere, I really look forward to reading every year, Charmaine Mosavoramani's annual outlook for stocks. It's fantastic. She's someone that I hope will continue to have her back as a thought leader, speaker.
She's spoken at the Friday
Yeah,
meetings.
a couple of times. She's phenomenal and someone that I really admire and really listen to. She's got great experience.
You'll have to wait till January.
Yeah, their piece comes out in January. We'll make.
I have to
make
January
sure.
too.
I'm sure you'll make sure everyone gets it.
Yes.
Great. The performance update, and we had your commentary, Mark. Mark, commentary, Steve. Any other items for the public agenda? Let the record show that Anthony Giordano is now present. And that brings us to the conclusion of the public agenda. Their motion to go into executive session. So moved. And is there a second?
Second.
Great. Any questions, concerns? All those in favor of going into public agenda? Public session, please say aye. Aye. As opposed, say nay. Great, we're now in the executive session. Welcome back to public session, and I believe we will have a readout from our own TRS's Priscilla Belli. Priscilla, I see you. How are you?
I'm good. How are you, Mr. Chair?
I'm fine, Priscilla. Great.
Thank you very much. Okay.
Thank you.
In the executive session of the Passport Fund, there was a manager update, and this was followed by two presentations. One, there was an international small cap presentation. Consensus was reached. There was a US large cap growth presentation. Consensus was reached. In the executive session, of the pension fund. There was an update on preliminary performance. There was an alternative credit presentation. Consensus was reached. There was a country waiver request for an infrastructure fund. Consensus was reached. There was an infrastructure presentation. Consensus was reached. The board heard presentations on 2026 annual plans for the infrastructure and real estate asset classes. Consensus was reached on both. There was a private equity presentation. Consensus was reached. And finally, there was a securities lending update, which was laid over from the October 16 investment meeting. Consensus was reached. Details to be made available at the appropriate time. Thank you all.
Thank you, thank you, Priscilla.
Thank you.
Appreciate it. Great, and as always, I'd like to extend a thank you to Adrian, our TRS.
Richard.
I'm sorry, saying Rick, oh my son, that's what you're saying.
Thank you.
Rich, I've been calling you Adrian for the last couple of hours, sorry. Rich, you got that, Will?
Autocorrect.
So I could, and also thank Will, thank you. And before we adjourn, I need to say, or we need to say goodbye to someone right now. And I started writing something down, but I couldn't. We need to say goodbye to a friend. This is Steve's last time he'll be here at the board investment meeting. It's been a good ride, Steve.
Thank you, Chair. It's been an
You've
honor.
given us good returns. I love every time that you would come and I would call you among the three trustees, we would refer to you as the professor.
That's very kind. What do you call Ed?
What do you call me? And you've enlightened us. You've been an asset to TRS, and you always had our fund and our members as your highest priority, and we certainly appreciate that. It was an absolute pleasure working with you for all the last couple of years. Thank you for the good returns. Thank you for the good camaraderie. Thank you for your friendship. It's going to be difficult. It's a sad day for us.
For me too.
But it's a happy day, I'm sure, for you. We wish, you have for the teacher members at least, the best of everything in your new endeavor, in your new position. They've made a great decision to hire you. Thank you for being so transparent. Thank you for returning our phone calls. I have your number in my cell, and I can't remember having a cell number of another CIO. You're just kind and generous, and I wish you the best.
Thank you so much, Tom. That's wonderful. It's been an honor. It really has.
Thank you.
And you still have my number, and call me anytime if there's anything I can do to help.
Thank you. So on behalf of the board, thank you. Oh, thank you, Steve. Thank you. And with that, we have come to the conclusion of our public session. And thank you, Rich, for everything you've been doing last few hours. Is there a motion to adjourn?
So moved.
Second. It's been moved, and has it been seconded?
Second.
It's been seconded. Any questions, concerns, comments? And all those in favor of adjourning, please say aye. Aye. Those opposed say nay. Abstentions? We are adjourned.